Okay, welcome back. This is part 3 of Design Your Own Trading Methods. In part 1, we learned about the process we learned how to map swings. Now in part 1 we learned about the process that a swing goes through. In the end it'll look like a swing, but there's a process that it goes through with contraction, expansion, contraction, expansion, reverse, right? There's a whole process. The more we know about the process, the more we can observe the behavior, and through that observation, design some methods in any part of the process. In part 2, we learned some definitions and to make certain distinctions, and this is very important in a market. They're not setups. We need to be able to map a market and able to make sense of it, right? And able to have a point of reference. Even if you put a moving average on here, that's in a way giving you a point of reference, price relative to that. And so we use some very simple things, gaps, swings. So we need to be, and we made some definitions, the impulse leg, the reaction leg, the pivot component. That was in part 2. Now here, part 3, we're going to talk about the 3 basic ways there are to trade. So we want to understand this as we drill on down towards designing methods. There's 3 basic ways. Three basic methods to trade. Basic, okay? 3 basic methods of trading. And let's just start over here. Brand new. There's 3 basic methods of trading that works with the process. You know what? Let's go over the slide that we built in the first part. Okay? So this is the first part showing a swing and the process that swing goes through. You can go back and review this, right? There's a swing. We can now say this is a swing, but it went through a process. It went through contraction, expansion, contraction, expansion, contraction, expansion. So knowing this, right, the minute you see contraction, expansion, this market is in play. There's lots of things you can start to do. So knowing this, we can come up with the 3 basic methods of trading. And that is, in the contraction, you can range trade. That's the first method, range trading. When you come out of that range, the next method would be breakout trading. Now, I usually make fun of breakout traders quite often, but I breakout trade. But I don't do it in a vacuum, right? I'm not going to breakout trade, say, new highs and lows. I'll understand parts of the swing, and I might do my breakout trades in different areas in context. Because, when you breakout trade new highs and new lows, what often happens? We swing back in, you get a little tiny piece. So breakout trading is the second method. And we can do that in intelligent ways. And then the third method is swing trading. All right, so after the process, range trading in here, breakout trading, or swing trading. And swing trading can be a combination of range and or breakout. So 3 basic types. Other than those 3 methods of trading, I mean, we've nailed it down. Now we can build methods off of each one of those 3. Other than those, the rest out there is prediction. Okay, it's prediction. Swing trading is a reversion back to the mean. Breakout trading is boom. Range trading is, don't buy into sellers and don't sell into buyers. Anybody ever try to buy into sellers here just because it looked good. I learned all these lessons the hard way. So 3 basic types. Anything else is prediction. Magic waves, magic numbers, magic math, magic whatever. It's prediction. Planets aligning. It's prediction. Good luck with prediction. So that makes it easier when it comes to us designing methods. We only have 3 basic venues we can start to design in. And so keep in mind that this is just a model. You have to be able to see it in price. This is a conceptual model, a framework. So you can see here, look, and you don't need much. You need the ability to see contraction, because contraction leads to expansion. And don't make it complicated and technical. Okay, all this is, look, you draw a single box off of as many things as you can capture. What this is price comes up, but sellers whack it. And you ask the question, what happens next? It can't make a new low. It comes up, sellers are still here again. This is proof. Can't make a new low. Fact. Comes up, comes down, can't make a new low. Right? This is a range, right? There's range trading in here if there's a big enough place to do it. This is a range. So we can develop tactics for range trading, even up in here. And then what happens after contraction, right? Contraction will lead to expansion. Now we're in the process of a swing. And that's where we can work on some of our breakout tactics. And then price will contract again. It's just a process. It doesn't know it's going to be a swing yet, right? It keep being an impulse leg. We're just still the impulse leg here. And then as it comes down, back into often somewhere near the breakout, not always. And then we start to swing and start the whole process over again. Contraction, expansion. Now, sometimes the contraction is little, you can't do range trading. Sometimes even the range, the impulse is small. So this is a model, and you apply it to your markets. But you need to be able to learn to read this. That's all. So that's our 3 basic ways of trading. Let's show another slide just to give some ideas. And go back and look at some of the other videos where we talk about the 3 types of trades and mapping, and gaps and swings, and that'll help all of this come together. So this is what the market does: contract, expand, continue, or expand reverse. So imagine contract, expand, contract, and contraction can be sloped. It doesn't have to be horizontal. And it can contract, continue, or it can contract, reverse, giving you a type 2 trade, opening up a swing. So just looking at this, you can see that there's lots of ways we can think about trading. We don't know live in real time what trade is going to be appropriate. You don't need to do all 3 trades. You don't. But you should understand the process. You can specialize in swing trading. You can specialize in range trading. Sometimes range trading is really easy because the markets, all they do is they probe their little ranges back and forth and just get everybody juiced. But you should understand the whole process. This is what price does in some manner. And so in a momentum market, there can be, so I'm just going to give you an idea about some of the setups we'll be talking about, and a market that is geared for some momentum, and that will be determined by the context. You can't just do these trades in a vacuum, like I said. So in a market that's in some momentum, I'm going to buy the bottom of this range for an expansion, or even do the breakout with a small stop and run it quickly, because the conditions will be momentum. That's one method we can use. Now that we've talked range trading, we can put the range trade up here. The other method would be the type 2 trade, when the swing is getting ready to just expand a minor into a major. You can do a type 2 trade in here. And again, this will often be a contraction down here, and there can be a breakout trade. And then there's the reverse trade. And so imagine the reverse trade horizontally would look like this. Zoom. That's this line. Retest. All right, that really covers a lot of ground in a nutshell. The next thing we have to do is, again, we have to learn to understand our market. No matter what market we're on, we have to learn to map and understand it. And with swings and multi-pivot lines, look, if you can just look over here and say, oh, look at that. Sellers, sellers, new low. Sellers, sellers, sellers. Could not make a major new low. Zoom. So when I get up here, I'm going to want to push this market in some form or fashion. Now, I rarely ever want to break out with the ES. But you know what? The breakout trade is appropriate sometimes. Sometimes the ES just spends weeks driving, slowing down and driving. So you can't just use them in a vacuum. Sometimes it's appropriate. What's needed is an understanding, and just by seeing some simple things with a map, just by making some simple distinctions, new low, new low, new low, higher low, zoom. Then I might use, say, a setup that looks like this and buy the median line. Why? Well, the median line is a swing trade. It's a reversion to the mean. Why wouldn't I wait for a bigger one? Because there's momentum, right? There's an understanding needed in your market. There's momentum because we're now, all these people, they tried to sell it, they tried to sell it, they stepped on them, they stepped on them, and now they come busting out. They got a little ways to go. There's momentum here. So this understanding comes from you being able to map markets and looking at markets day after day, practicing, researching. I'll probably do a whole separate blog on this understanding versus probability setup nonsense. But how we approach these things is important. So, for instance, it's pretty exciting when you think about it that you can even follow something in a process. Now, I might draw a model like this, and I'll tell you all this contraction. I don't know which way it will expand, but when that puppy expands, it's liable to blow for a while, and then slow down, contract in some manner, either continue or reverse and turn into a swing trade. But once I get here, right, this contraction, how hard is it to identify? And there's a good range in here. We were range trading this several times in December, and even talked about it in January. So that would be a range trade. So just what you see using maybe a euro, that would be a range trade. Okay? Now if you bust out of this, there's a possibility for a breakout trade. Now there's several different tactics to a breakout trade other than just, because you'll notice it likes to poke, likes to poke and probe. You'll know when it goes because it'll do something like that. And so there's several different tactics to a breakout trade. So now we're in this part of the process. Okay? And then later on, this market is now in the swing possibility part of the process. We'll look at several markets just to practice at least mapping contraction, expansion. See, there's contraction. Look at these bars. Right? That's a gap. That's all gap. And then contraction. And simple breakout. This would have been a good breakout trade. But again, you don't do it in isolation. This is a setup I use. Instead of swinging, if the market's got momentum, it's probably only half done and wants to finish its impulse leg out. And so this is a setup I will use with various tactics. Okay? Various tactics. But as long as you're able to see this, you know what? You can research it yourself, and then you can research the different contexts these things are in. You just need the ability to see that, or you need the ability to see a multi-pivot line. It's been tested many times. And by the way, to project a multi-pivot line, whenever you get a gap, the minute it starts to hinge like that is often where what we call the gap slide or the shelf will start. And that'll be your first form of support. There was a possible way to come in here and trade this and try to get long for a whole nother run. This one, came all the way back to the scene of the crime. So you just need the ability to map gaps along with swings, and just notice when contraction gets popped. Just notice it, right? Just notice when there's a heavy area. Excitement happens. In that excitement, we can build methods. We want to trade markets when the markets are excited about something. We don't want to trade in just blah, blah, blah. We want to trade when they're in play in some way. Okay? And what often puts them in play is busting a multi-pivot line. You come up through a high, you come down through a low, they become in play. So we haven't built official setups yet, but as we do, you need to know how it works, how it's built, its process. When you know this, you can use it. Otherwise, you're just borrowing it. It becomes yours when you know the process. When you know the process of any setup you've learned, you can tweak it, you can change it to conditions, you can adapt it to conditions. It becomes yours. All right, you just can't plug and play. Trading is not getting a set of instructions. Buy this when this happens. When you're on the 50 moving average, blah, blah, blah. Or even when a median line is touched, then you do this. Trading is much more fluid. Real trading is more fluid than that. You might have to start out with instructions at first. And that's how we all start out learning, right? You follow the instructions. But trading is fluid. The market will be in a different set of circumstances every day. Okay, there'll be a different set of circumstances going on, and you have to be able to get some sort of situational awareness of it. And how do we do that? We do that by mapping. And then when you do that by mapping, then you also understand something more about the lines and how to use them. So I just wanted to talk about the three basic methods, and we looked at currencies, we looked at the ES. Let's look at a few stocks even, okay? Let's see if we can find some things in here that are alive. It looks like in stocks, some things like the railroads, all the energies are up, everybody else is getting killed, chemicals. Okay, so look here. Even if you look at this much data and you frame it like this, you still need to see contraction, expansion, contraction, expansion. But just focus in, right? If you understand the situation here, look at the situation. It's trying to swing. You can feel them in here, right? Now, let's just come here and look at this. You need the ability to map, that's all. We have contraction. And so we'll be able to follow this one live in process. You have contraction, expansion, right? You see how it, look at the bars. They're mostly higher highs and higher lows, higher highs, right? It's shoo. You can see it. It's busting up through things. And then what's it do? It stalls out again. This is the process. Now, this trade will either expand, continue, or expand, reverse into possible swing or an actual reversal. Which one do you do? Well, you look at the situation you're in. It looks like they're chomping at the bit in here. Buyers picked it up. The buyers are chewing through the sellers. Buyers picked it up. They're fighting with the sellers. You got a little pressure cooker here. Price always wants to try and go for new highs, new lows. So we'll watch this one live and see if it's a possible trade to expand through the highs. Nobody knows for sure which one to do, right? Do you wait for it to swing? Do you do that? Watch it live and learn. Can you identify contraction, expansion, contraction? Well, then you can do your own research. This one was very similar, but it's already done its thing. Expansion, right? See, contraction, expand. And often the next expansion is going to be about the same length as, you know, the last impulse. And what's happening when you get this is instead of swinging, it just paused. It's building a bigger impulse leg to later on somewhere produce a swing. This will produce a swing one day. It's not going to go straight up forever. Okay. Let's see what else we have. We already looked at that. This one, they're inching with the highs, but just be able to block it out. Contraction, expansion. We'll see which way it goes. And we can look at it to the downside too. So a lot of these stocks that were everybody's favorite are doing the same thing to the downside. Can you map? Can you map? Can you see the contraction? Can you see the expansion? Can you see the contraction, right? This is going to bust one way. It might probe a little bit here and there, but it will expand. It might expand back up to make a swing, or it might rock and roll through the lows. In this case, it's a bit of a special case, right? It's leaning on all of this, and so who knows, right? It's a different context. It's a different context. This is one we listed in our stock list earlier this month. Bristol Myers for momentum. Just see it. Boom. Boom. It's pretty. It's got momentum. Text and process. So you'll see these things to the downside, to the upside. Let's look at a couple more downside ones. Let's find a good one we can track. AMBA. Actually, Qualcomm. Let's put Qualcomm on a weekly. And look at how pretty that is. Contraction. expansion, contraction. Now just in this range, every time it probes, there are really good range day trades. Look, there's over 10 points in here in each one of these bars. There are really good range day trades in here. You get an idea how we can use this? So we don't know if this one will come down to make a swing or not. But what you can notice is where in the swing is it? It's happening above a high rather than below a high. So let's see how it resolves. All right, we'll see live. CAG. Okay, here's a real good one. You can see the expansion is beautiful. Oil stocks have been nice. So this will be a great one for us to follow because we've just expanded and we've just contracted again. Do we continue or do we swing? And, you know, not to leave natural gas fans out, just see when there's a contraction, there's an excitement. This one is swinging now. What did it run into? Each one of these charts is in a different situation, and there's no way to write down every situation and what to do as if there's always a yes and a no. So we just kind of talked about a little bit on possible methods of trades and 3 basic methods of trading in this video. So it's going long, so we'll wrap it up.